Well, I am sharing something with you, Bram. Bram Vanderelst is a trader and a person who has brought together an initiative with the Curzon group, where he's developing the uranium, but it's a much broader platform of growth with respect to this industry. Independent people operating with respect to trading, aggregating resources, liaisons with utilities. There are very few independent operations around. Cameco is vertically integrated, the French are vertically integrated, others are vertically integrated. So it's incredibly important that people, investors and others get independent advice and also independent source of material. I've learned a lot from Bram in 5 or 6 interviews that I've had with him, and Bram is actually, I think he's headquartered in Cyprus and operates effectively globally. I'd like to hand over to Bram to talk about the uranium market and market structure, and great to see you. So how are you, Bram?
Very good. Thank you very much, Lawrence. I hope you can all hear me fine. Great. Thank you very much, Lawrence and Peter and the PAC Partners to invite me onto this forum. I know it's the end of the day for everyone, so hope you can all spend another 30 minutes to listen to the presentation of somebody who's operating a slightly different part of the market as an intermediary, as a trader, which is a part of the market that's a bit more obscure than the utility side or the miner side. And hopefully I can give you some insight into how that market operates. But let me start with sharing my presentation. Hopefully that goes all right as well. As I said, what I'll be talking to you about today is first and foremost, what's the role of an intermediary and what does an intermediary like ourselves do in the market? How does an intermediary get set up, and then what does it provide to a market that's essentially a long-term market? I'll then guide you to some of the details on how our uranium market is structured, and you're gonna have to bear with me on that. I'm gonna explore some concepts that are probably very familiar and very simple for some of you, but I'd like to really do that so we can go into a more detailed and better discussion on the following slides. And then I'd like to highlight some of the things that we see as important drivers for the market that currently, amongst one of them is like Sprott, obviously, and the advent of the physical investors that came to the market in 2021. But also the effect of the Russian war in Ukraine, what that means for our market. And then last but not least, I'd like to share some thoughts on the current status of the uranium market. And I've purposely put that last, so you all have to stay until the bare end of the presentation to understand really what we think of the market. So let's start with some history. As I said before, our uranium market is a market that's a long-term market. It's pretty straightforward. The only real usage for uranium is the usage in nuclear power plants to use as fuel and generation of electricity. And on the back of that, there's been a long-term market that's been developed, and that's still very relevant today between primary producers directly contracting with utilities. Intermediaries came about 25, 30 years ago to really sort of solve a problem that any commodity market has, which is a mismatch between a producer and a utility. A producer wants to get their pounds out of the ground and monetize them ASAP, whereas utility wants to buy as and when they need it to put into their value chain and then into the reactor. And sometimes there's a mismatch. So intermediaries initially provided that service to the industry, but then developed from there. As with any market, intermediaries became price speculators. And by now, about 25 years on, intermediaries are the de facto market participants in the spot market. And you can see that there on the graph on the right, where I sort of split out the transactional volumes between what is essentially the spot market on the left and the midterm and long-term market. And you see that on the spot market, the role of intermediaries as buyers has been by far the largest, and then has been growing over the years. And then to the other end of the spectrum, you see on the mid and long-term market, that is mostly or almost exclusively utilities who've been buying as long-term buyers of the uranium. As an intermediary, we sometimes get a bit of a bad rep, so I'd always like to set that record straight. We actually do offer a lot of services to these markets. As I said before, we provide timing flexibility, but that's not the only flexibility that we provide. We provide flexibility in terms of locational flexibility, where we can provide swaps to the market, timing flexibility, pricing flexibility, amongst others, where quite often we find ourselves in a space where, for example, a producer wants to sell market-linked contracts because they see market rising. A utility is more interested in fixed price contracts, and therefore there is a trade to be done between a market-linked and a fixed price contract. As in general, intermediaries provide liquidity to the market. There is much more intermediaries that are active on a day-to-day basis than producers or utilities, and that's liquidity that our market especially desperately needs because it's one of the major issues in our markets. And to that extent, intermediaries see most of the volume. There's a lot of churn, but they also see most of the volume. They act as inventory holders and inventory releasers at times of oversupply and undersupply. Intermediaries really smooth prices and reduce volatility, which again is sometimes counterintuitive, but especially the smoothing of the prices, because they can absorb a certain amount of inventory at times when there's too much, and they can release at times when there's too little. And I'll get into that in detail a bit further down the presentation. And then nowadays, intermediaries provide all sorts of funky structured products. We, for example, at Curzon Uranium, we have a lot of engagements with junior miners. We have done offtake contracts. We have done pre-finance offtake contracts. So all of that is now done by mostly intermediaries and banks and other balance sheets, rather than utilities who are very, very focused on just running their reactors, optimizing their reactors, and buying the fuel as and when they need it. This is where it's a bit educational, so I'll go through it very quickly. But our market, in terms of structure, is it's a long-term market and a contango market. Our market is very open to financeability because it's a fungible, non-perishable commodity. Our market's been more or less always, or at least as long as I've been in the market, which is about 10 years, has been in contango, meaning that the forward price is rising. And the graph I put on there, or the plot that I put on there, is essentially a look at a bunch of different forward curves from 2012 all the way out till now. And you'll see that despite the underlying spot market going all the way from $17 to $64, the forward market, or the structure of the forward market, has always been in contango, where the forward price is higher. And that's partly because of the financeability, the carry trade, which I'll go in detail about in the next slide, and I'll give a bit more detail on how that forward price, how that is established. So as I said, it's a long-term market, but the spot market is still essential. I see a lot of presentations from the larger primary producers who sort of want to reduce the importance of the spot market, which I think personally is not entirely correct. The spot market is ultimately a pool of liquidity for over and under production, or for fuel adjustments for the utilities. So it works for both the producers and the utilities. But also, very importantly, even though it's being a long-term market, a large part of the long-term market, if it's priced on a market-linked basis, is priced against that spot market. So if you have a non-functioning spot market, then it's very hard to price against. Then it's in everybody's best interest that the spot market is actively traded, and that it provides a real price discovery rather than an obscure indicator. And the spot market also does provide material for the carry trade if there's excess material, which I'll go on in the next slides. And then maybe also a very important thing that I always get a lot of questions about is, what about supply demand, and why does supply demand not get reflected in price? That's also part due to the structure of our market, because our market is somewhat insulated from the immediate changes in supply demand, and a supply glut or a supply deficit don't always directly translate into a price change, and that's because of the long-term nature of contracts who sort of insulate that the overall pricing from that deficit or glut, and also the carry trade. So let's look at the carry trade in a bit more detail. I'm sure you're all familiar what a carry trade is, but very simple terms, it is if there's some excess material in the spot market you get somebody with a balance sheet to buy that material, simultaneously then to conclude a sales contract on the forward market, so a few years out to up to 10 years out, with a utility or another creditworthy counterparty, and essentially carry that material on balance sheet until the time of delivery in the forward. And as long as the yield or the yield to higher prices in that forward market is above the cost of that carry, so the combined cost of financing this material, storage, and other costs, then it is a profitable trade. And the carry trade is really, really important in our market, and that's it's a function that has really been very important, especially in the bottoms of the bear market, 2015, 2016, when there was so much material out in the market. We were in oversupplied market, and essentially the carry trade made that we didn't trade at $5 uranium, but we stayed around the 20 level. And that's because you had essentially a displacement from future demand into the spot demand through the carry trade, because every single time somebody puts on a carry trade, it essentially means that material is soaked out of or is absorbed from the spot market, and it is pushed forward onto the curve onto a forward demand. We then also have, and that's what we're seeing right now, which is why I wanted to really show this slide, because it's important. We see the unwinding of the carry trade, or the reverse carry trade. And conceptually, it's very simple again. It's somebody who was previously put on the carry trade, who's got material on balance sheet, who will now sell this material into the spot market and simultaneously sign a forward purchase contract to cover their exposure to the original carry trade in the forward market. And so what that means is that you see essentially additional spot material in the market that wasn't there before. But the really important effect of that reverse carry trade is you see a rebalancing of our market across the whole forward curve. And so what I mean with that is that material that was originally carried into a forward demand, and that was therefore meeting forward demand, is now no longer there, and that forward demand now needs to be met by production coming out of the ground, and vice versa. On the spot market, the material that wasn't there is now being met by this reverse carry trade. And that's an interesting impact that we're seeing right now, where we essentially see our whole forward curve rebalancing, and it's partly a reason why Sprott, for example, is seeing much more material than people anticipated when they first started. And that's thought I want to leave with you while I'll explore the rest of the presentation. But just one real life example that's out in the public is for example, Cameco. Now, what I've done is I've taken two of the last quarterlies from Cameco, and I've looked at their forward purchase commitments. The top one is the Q2 forward purchase commitments published by Cameco. The bottom one is the Q3. And what you'll see is that essentially between Q2 and Q3, the future purchase was reduced by about 140 million Canadian. And that's quite significant, because that's about 3 million pounds of forward purchase commitment that Cameco has on their books that's no longer there. And one could infer that that means that Cameco is taking delivery of that material sooner and essentially unwinding the carry trade from somebody who they bought it from, the balance sheet that they've had that forward purchase commitment with. And so that is material, 3 million pounds that wasn't available in the market originally. Cameco needed it because of their slower restart with McArthur River, and they managed to find it from forward purchase commitment. But it also means that in their contract book in 23 and beyond, all the way out to 27, they now need to produce that material to produce into those forward commitments, into their contract book, rather than having it from balance sheet. So that's what I meant with the sort of the rebalancing of our market across the curve. If we then go into a bit of detail about what has Sprott meant for the market, and I can't stress enough that it's meant a great deal for the market, but it hasn't really changed anything structurally, or it hasn't really done anything that is out of the ordinary. The way that I look at Sprott, or the way we look at Sprott, is it's turbocharged something that was already underway. Sprott has taken about 40 million pounds out of the market in total since 2021. But the rebalancing of our market was something that was already underway. Our market has been in supply deficit since 2018. And so the Sprott is turbocharged that. They soaked up a bunch of inventory, freely available inventory that was uncommitted, that was speculative. So they really soak that up in a lot quicker fashion than we would have otherwise seen through the normal market actions. As I mentioned before, because of the unwinding of the carry trade, they actually came into a lot more material than they initially thought. They initially thought that they would maybe with 10 million pounds, they would hoover up all the free material, and from that onwards, the sky was the limit. But because of the structure of our market and the financeability of uranium and the carry and the reverse carry, they're rebalanced that market, even though they themselves are only a buyer of material in the spot market, but other actors can rebalance it for them. And essentially Sprott, the 40 million pounds, that's been taken out of the market, has really rebalanced the whole curve. Sprott is important in our market. It can provide a floor at times to our industry, which is well, for all you primary or junior producers in the room, it's important to have that floor and to have some pricing certainty to make sure that the pricing doesn't drop underneath you. It sequesters pounds for a very long time. So essentially, it's the equivalent of a utility putting it into a reactor, because those pounds are, at least in the near term, not going to come back onto the market. And it really provides a competition for utilities. But Sprott also, if I look at it from our intermediate perspective, it also has some secondary, potentially negative side effects. It's, in a way, it's reduced liquidity in the market. And if you look at the graph on the bottom left, you see that in sort of August, September, October time 2021, you had a real spike in transactional volumes, both in volumes and in number of transactions. And that was really the early days when Sprott came into the market, raised a bunch of material, raised a bunch of cash, and bought a bunch of material. And that was all the freely available inventory, the uncommitted inventory that really needs to be flushed out of this market. That went on for a while, and then Sprott sort of was active in early 2022 as well. But due to the downturn in equities market in general, and therefore Sprott trading at a discount, they weren't able to raise financing. And we haven't seen them buy as much as in the last year or so, in the last 3-4 months. And that's really reflected in that chart, where you can see the transactional volumes and number of transactions in the last 3-4 months has really dropped to a low that we haven't seen for quite a few years. And we as a trader in our market, we see that there is less liquidity, both on the offer side, because Sprott's hoovered up a lot of the material, but also on the bid side. There's just in general less liquidity. And that's, in my opinion, at least, not really good for its market. Sprott has also created higher volatility in the market, which is an effect of everybody looking at the same thing. Now that Sprott is out in the open, they publish as a traded entity or as a listed entity. They publish when they raise money, they publish how much pounds they buy, they publish essentially everything. And so we as a trader, we all look at that. We all look at the same thing. And at times when Sprott is buying material, you'll see the price going up much further because people anticipate Sprott buying. And vice versa, when Sprott isn't raising money or not buying material, the price sort of drops further down, because all traders see that as a bearish effect. And so what we're really seeing is most traders being positioned at the same or on the same side of the market, because of Sprott being the other side of the market at times. Whereas if you go back 4 or 5 years ago, there was a lot more discretionary trading, because there was contrarian views amongst traders and there was a lot more activity. So in a way, Sprott has really reduced liquidity and created higher volatility. But in general, Sprott has become a large part of the market. It's something that we can't deny, and it's something that we as markets need to live with. And it's to a large extent, it's positive to have Sprott in our market. If we then have a look at what the war in Ukraine has meant for our market, which is not a really big event this year, obviously. Again, first, a couple numbers. The war in Ukraine and the adversity to Russian material is really a story of conversion enrichment. And I want to really put the production numbers and capacity out there, because uranium isn't all that important in Russia. Actually, Russia is a net importer of uranium. They only produce about 6 or 7 million pounds, whereas their domestic demand is about 50 million pounds. So they're short uranium. They do control a lot of mines in Kazakhstan, which they funnel into Russia, and therefore they're adequately covered. But Russian sanctions or any sort of embargoes on Russia wouldn't necessarily mean an important stop to uranium or uranium. On the other hand, conversion and enrichment, which are further down the value chain, are heavily impacted. And we see that right now already, where Russia is of current production capacity, 38 to 46% of those two components. And that's really where the story is. If you look at the graph on the right, we also see less UF6, which incorporates conversion, and EUP, which incorporates enrichment, volumes being traded on the market because it just isn't there. It isn't freely available. If we look at the market effects, there is a lack of conversion and enrichment capacity in the West. So there's a need for Western supply chain to be built, but it only will happen when the prices are incentivized. And same as for mining, you need incentivizing prices on a long-term basis to really build that supply chain out. And when that happens, it will still take 5 to 10 years to build that capacity. So it's really difficult, and it does have secondary effects onto our uranium market, the U308 market, which I'll highlight right now. As I said, Russia is a net importer, so less effect there, but a lot of physical material flows through Russia, and that's highlighted by Curzon in every single conference call they do, where they're now trying to reroute uranium away from the Russian route through St. Petersburg, through the Caspian route, or even to China. And some real disruption via the Russian route could really mean a meaningful impact, not because the material isn't there, but the material just can't move to our Western markets. In general, what we really see is a shift away from Russia as a supplier, and that is regardless of the outcome of the war. We see Western utilities especially, but utilities globally, who are moving away from Russian supply for the long term. And that is there to stay, whether the war would be finished tomorrow, and let's all hope for that, or the war is going to go on for a few more years. That's not going to change. The war has really highlighted that the Western supply chain wants to move away from Russian exposure. Another effect, and this is an important one, is the change from underfeeding to overfeeding. And for those who are not familiar with the term underfeeding, it's essentially a process where an enricher saves uranium on the front end of their process by not feeding as much uranium into the process as they should, because they've got excess capacity. Now that Russia has been sort of blocked, or at least people are moving away from the Russian market, we see a real discrepancy in where the capacity sits. The Western market capacity is fully utilized, and there's not enough capacity, which means that underfeeding is completely done. And essentially we're moving to overfeeding, which means that more uranium needs to be fed into the enrichment capacity to make up for the lack of capacity, to ultimately create the same product at the end of the enrichment cascades. On the other hand, obviously Russia has more capacity because they're no longer supplying some of the Western countries. However, there's also technical limits to how much underfeeding can be done. And even the feeding gets done, that Russian origin uranium or origin material isn't going to flow into the Western market as much. So we really see there being a discrepancy, and the underfeeding and overfeeding effect is, in theory, very large. It could be a net effect as much as 30 million pounds. That net effect will play out over a few years because there is historical contracts. The Russians are still delivering into this historical contract because there isn't any ban or any sanctions yet. The price setting and the setting of the tails assay, which determine the underfeeding or the overfeeding, that's all being worked out. And so that will be an effect that manifests itself over years. But the net effect is very large, especially knowing that we're already in a supply deficit. If you now take out a very large important source of secondary supply and flip it essentially on its head as a source of secondary demand, that's really the takeaway for uranium from the Russia story. But also we see that there's save valves in this story. We already see that there is an increased flow of EUP from Russia to China, for example, which then has a knock-on effect that Chinese buyers will buy less Western EUP and therefore sort of rebalance things a bit. So that's something that we'll see also play out over the next few years, where some of the flows and the global flows will readjust to negate some of the effects or the negative, depending on what side of the coin you're on, some of the effects that you'll see from the Russian war. And then last but not least, let me talk about some of the market trends that we see based on some of the conversations we just had. On the supply side, let's start with supply. On the supply side, we see that supply largely becomes contracted. When I started in this market 10 years ago, there was a lot of uncommitted supply, most notably from the Kazakhs, Uzbekistan, people like BHP and others. Whereas now it's harder and harder to come across uncommitted supply, and most prime producers are fully contracted with utilities or other people in the market, which again sort of shows that drain of liquidity in the market, but it's fully contracted. Existing supply is feeling the inflation burn, like everybody in this market or in the mining sphere, and that obviously reflects in higher price or higher price expectations. And so the way that we look at supply, what that means, because of the rebalancing that I mentioned earlier, the contracting of all of the long-term supply from the primary producers, our market is heavily exposed to new mines coming online. There's plenty of uranium out there. There's plenty of projects that can supply uranium, but it's really a matter of at what price and what time. And this is key, because with the rebalancing, the undersupply in our market is going to manifest itself in future years, in 23, 24, 25, and beyond. And if there's no supply, and if there's delays for whatever reason in new supply coming online, we're going to be in a real supply crunch, because inventory is being drained, the loosely available, the greasing of the wheels has really been stopped a bit to a certain extent by Sprott and others, and the supply deficit that we've seen over the last four years. So that's an important takeaway from that. If we then look at where does the production come from, it's a combination of a variety of projects, amongst others, all of the projects that you've spoken about today. But then the big elephant in the room is Kazakhstan. There's a view that Kazakhstan can just keep producing. We look at it slightly differently. Kazakhstan has a few issues. First and foremost, a lot of their assets are depleting by the mid-2030s. So from a strategic perspective, Kazakhstan doesn't really have an incentive to go full out production, because the price currently isn't there to support that, or at least it's not the most strategic decision to do so. And they want to keep their assets for a longer term. But also Kazakhstan, and as they publicly have communicated, are currently facing issues with production materials, which is why their 23-24 guidance is potentially on the threat. The transportation issues, getting into the Western market, so there's no point in producing if you can't get into the Western market or the markets in general. And then also, which is not talked about very often, but if you're 42% of the market, there's only so much you can increase that. The Western utilities aren't comfortable with buying 60, 70, 80% Kazakh material. So you might be able to produce it technically, but if you don't have a market to put it into, there's no point in producing it. So that's a bit of color on the Kazakh story. The graph I put on there at the bottom is essentially our in-house Curzon Uranium supply demand model. The gap analysis that you'll see that are negative and sort of essentially show the undersupply is a difference between the demand, the operating reactors, the secondary supply, and the idle uranium or the idle uranium projects that are coming back online. So you see that gap is widening and is growing very big. However, there are enough projects in the supply pipeline and perspective that could fill that gap, as you can see from the bars, that could even outstrip demand. But as I said just now, that's really where we need to see more uranium mines coming online. And that obviously requires a certain level of pricing, which is, in my opinion, well above the $50 where we are today. If we then look at the other side of the coin and we look at the demand side, demand is about as good as it has been since I've been in the market, and probably about as good as it's ever been. So the outlook is incredible. We've seen more reactors. We see more plans to bring reactors online than ever before. We see the Chinese full steam ahead. We see the Western markets, which were up till about a year or 2 years ago, were declining markets, now really reversing course and extending lifetime of reactors and really going full in on uranium, bar maybe like Germany and Austria or a couple other Europeans. So the demand side story is it's incredible, but that doesn't get translated yet in real contracting. And so the chart at the top right is long-term contracting published by TradeTech over the last 15 years, and you can clearly see that with the gold line being replacement contracting at the current demand level, that we have been under replacement contract for a while, and that's quite logical because we had over contracting in 2005 to 2010, which means that over contracting has been pushed forward into the next 10 years, and obviously that fills the gap. Plus the carry trade of the additional material that was available in the supply glut, that's also playing a big role why contracting didn't need to be done until now. But we really see contracting improving again, especially in 2022. We really see that there is a lot more long-term contracting from the utilities, but we're still not near replacement contracting. So that is still a big driver for our market that will be played out in the next couple of years. On the demand side, we see less and less material available. And so it's the way I look at it, if you're the first 70, 80, 90% to a certain extent that's looking to contract, you'll probably find the material, and you'll probably find the material in that long-term window. And if you're willing to engage with some of the juniors who are promising to produce, you'll definitely find the material. But it's that last 10, 20% of utilities who are contracting a bit later or leaving it later in the cycle to contract, they will struggle finding the material, and they will also come up against the issues that certain producers might not produce on time, on budget, or at cost, and therefore will see potentially not enough uranium available to them as and when they need it. And that's why in my view, our market needs to adjust to that right now, which we need higher prices for. And that's the conclusion of my presentation. I hope I didn't bore everybody to death, and I'm happy to take some questions right now to see if there's any further interest in the role of an intermediary in our market.
Bram, thank you very much for taking us through this. There's elements of time, there's elements of supply, there's demand, there's the different stages of production. This is a complex market, and certainly I've learned a lot more than I had ever thought over this longer period of time that I've been trying to get my mind around the uranium industry. But I'm just wondering, I might ask a question here and certainly follow through with you. No, I've actually got a question up the back there. Do you want to start off, Stephen, please?
What's the expect for next year? Repeat the question.
Yes, can you hear?
So I can't hear the questions. I think you're gonna have to come up with a mic because I can't get the questions otherwise.
Sorry, I've got a microphone.
Yes, I'll oh, you've got a microphone.
I managed to get a microphone.
Yeah.
So last New Year's Eve, I was having a quiet time, and then Ukrainian war. So what's the X factor that I should watch out for on New Year's Eve for next year? Any ideas? Any thoughts?
That's a good question. Let's hope that we don't see any more civil unrest in Kazakhstan or the Ukrainian war. But our market is, to a large extent, geopolitical market. Some unrest in an important country like Kazakhstan is an outsized effect on our market, and that's something that that's been the trend for 2022, where supply chains are becoming more local and more tailored towards where the material is going to be used. And that's really what we see playing out in the next 5 to 10 years, where mining projects out of Australia, certain African countries, Canada and US will do really well, because there's an absolute need for those projects, because utilities want to make sure that they secure supply from what in their mind is a reliable source. I'm not saying that the Kazakhs aren't a reliable source, but it's much more exposed to geopolitical upset and uproar than a mining project in Australia. And I don't have any predictions for where the geopolitical world is going, but that's definitely a big trend that we've seen this year.
No, that I think those geopolitical factors are obviously extremely important. I'm just wondering from a processes reaction point of view, I'm just wondering whether the underfeeding, switching, and from overfeeding and underfeeding, just looking at whether there's an immediate catalyst for the ratio of, because different processes do different things, whether there's going to be an immediate a catalyst which will then change that supply dynamic in the and supply and demand dynamic in the very short term.
That's a very good question, and it's one that I can't answer without going into a lot of technical detail. But the short answer is yes, there is definitely an immediate supply effect, and one of the very simple ways of looking at it is material or previously enriched material, or the tails of previously enriched material that was depleted, was originally sent to Russia for re-enrichment of those tails and essentially production of new natural uranium UF6. That's a trade that's a material flow that's gone, and that has stopped from day one after Russia invaded Ukraine. And therefore, that's an immediate effect of underfeeding, or re-enrichment of tails that's no longer there. We see other immediate effects where utilities have re-optimized the way that they feed natural uranium into the process, and readjusted their tails assay, which sets the underfeeding or the overfeeding and the capacity needs for those contracts. So we've seen that play out as well. It's difficult to say to what extent we've really went from -20 to +10, so the 30 million effect, because a lot of the details are in the privately negotiated contracting between the utilities and the enrichers, and to what extent they set the parameters. But long story short, yes, we've definitely seen an immediate effect. The way that we model it, we've put our underfeeding from about 25 million pounds a year down to 0, because we don't believe there's much underfeeding left. But we haven't gone as far as going to overfeeding in our models, because we think that will take a while, and essentially will mean a lot of new contracts to be signed at different tails assays to show the overfeeding in our markets. And then, if I may, one last important thing to note as well is the availability of UF6, and therefore the availability of conversion, because you can only overfeed if the feedstock is available, obviously, and that feedstock is UF6. And as I showed during my Ukraine slide, the feedstock is really where the pressure is. There isn't enough conversion material, so the UF6 isn't necessarily there, aside from some pockets of inventory that could really make that underfeeding to overfeeding transition. So that's another important side note.
Yes, these localization of supply chains and the fact that the processing isn't there is a short-term problem, but it just denudes the pipeline into the future. I think from a market perspective, there's going to be a breaking point, and there'll be a change in the pricing regime for the whole curve, for the whole chain. And I'm not sure when that is. I like to listen to the Canadian analysts at the Cameco quarterly calls. They seem to be on top of this. They're speculating about this, but they haven't come to a conclusion. And when you do, Bram, can you give us a call?
If I know that myself, I probably wouldn't be presenting at this conference. But no, I think what you said is correct. We will probably need to see a shift in pricing across the value chain, so across enrichment, conversion, and uranium.
Yes.
We've seen it played out for enrichment and conversion to a large extent already. Conversion is now trading around $40 per KGU, where it was about 15, 20 only 2 years ago.
Wow.
Enrichment, same thing. We see it now trading at around $150 per SWU, where not even a year ago, enrichment was trading at maybe 50, 60. So that shift in the value chain products has already happened. What we're waiting for now is the shift in the original feedstock material, which is U3O8.
So, Bram, can you talk a little bit about China, please? Obviously, they're putting a lot of capacity in. Do you see them moving up and putting their foot on uranium production?
Yeah, so China is a good news story. So China, first of all, from a demand perspective and from a reactor build out, they are full steam ahead. They have the benefit that certain Western countries don't have, that if they make a decision that it gets done. And so China on the demand side is very bullish, and I think they've got about a CAGR of about 2-3% annually. So China really is a growth story. And despite a few years of less reactors coming online due to the effects of delayed licensing after Fukushima, we see them picking up quite aggressively right now again. And that's something that we see on the demand side. On the supply side, China has a policy of a third, which is essentially a third production from in-country, a third of production of material that they control but outside of their country, and then a third from the Western markets. That's where it's a bit more, I'm a bit more skeptical about China's ability. They haven't really shown an ability to produce a third of that demand from domestic sources. And from what I'm hearing, that's not going to happen anytime in the future either. So that needs to be filled somewhere else. China is obviously making a big push to own resources and mines that are outside China but are controlled by China. So, for example, the Husat mine or some of the mines that CNNC owns. And that's something that we see playing out, and we'll see China probably picking up more and more projects, most notably in Kazakhstan and their close neighbors, but they'll look further afield as well. And then China still remains a major buyer for material. If you look at Chinese import data, China buys a multitude of what they consume each year. We've seen that slow down a bit from the years where they were buying 2-3 times as much, but they're still buying more than they're consuming. And that is mostly because China sees uranium as a strategic stockpile, something that they want to keep in country for the long term. And therefore, we don't see China as a release of inventory, which I sometimes hear in the market, where like, well, but China is sitting on 400 million pounds of uranium. Yeah, that's true. But if you put that against the build out of their reactor fleet, that 400 million pounds isn't actually really that much. It probably is about 10 year forward reactor demand, but that's not outrageous. That's something that those numbers we've seen in Japan before Fukushima, and those numbers we've seen in other countries, that to have that sort of coverage, especially if you're a country that's geopolitically in the firing line, and that is also not really endowed with a lot of natural resources on the uranium side itself, that sort of makes sense. So that's my 2 cents on China. But I think China is going to be a country that keeps soaking up uranium, and if anything, it's going to keep buying the reactor demands. And the worst case scenario, that China will slow down its buying, but I don't see China as a release of inventory in any shape or form.